Good evening and welcome to Chasing Your Facts. I'm Sam Chase, your host, and with us this evening on January 11th, 2023 is Chelmsford's Chief Assessor, the man everyone loves to hate, Frank Reen.
Thank you very much,
Oh, I'm
Sam.
sorry, I shouldn't have introduced you that way, but you know, what the heck. We have to reinforce the stereotype.
That's exactly right. Trust me, it's well known, well established out there.
So, Frank, I'm glad you're with us, and I think maybe this is the third year we've done this. The fiscal 23 real estate property tax bills have been mailed out, so as soon as we can thereafter, we've had Frank in to tell us about that process and perhaps address some of the more common questions that a taxpayer might ask. So Frank, before we get into that discussion, why don't you just give us a very tiny snapshot of your bio, and then we'll get into the meat of the discussion.
Certainly. Thank you, Sam, for having me. I've been in assessing for about 30 years now, 29 years. The first 6 or 7 was spent as the assistant assessor in Reading, and then I took a lateral position here in Chelmsford. And then my predecessor now retired, and I was fortunate enough to get the position as chief assessor, and have held that position for some 21, 22 years now.
Yeah, I remember that. I was on the finance committee at the time.
That's right.
And I remember when you were hired, and I remember Bernie Lynch, who was the town manager at the time, telling us that, that you were going to be promoted into that job, and then you very shortly thereafter you came and talked to us at FinCom.
Yep, that's
so
right.
It has been a long time. So certainly you've got lots of experience in the area, and of course the assessing process itself is very, very technical. So why don't we start by having you give us a little bit of a insight into how we go about determining an assessed value for a residential and commercial property.
Taking the residential first, it's basically done through an assessment sale ratio process. We get anywhere from 300 to 375 sales a year that are considered arm's length sales. That is, that they're valid sales, they've been vetted, the willing buyer, willing seller with separate interests, that the sale price reflects the same thing as the assessed value. So once we've done that, we establish what's the assessment sale ratio currently. So we take the assessed value divided by the sale price, that gives us our assessment sale. We sort them high to low and just look at the median. Everything's based off the median. The median, the DOI would want to see anywhere from 90 to 105, 110 is the median. This year starting out, it was probably 83, 84, very low. Some areas even lower. So that would be the overall. And then we take a look at sorting it by style of home, age of home, condition of home, lot size, location within the community. That location within the community, lot size, works towards, of course, our land valuations. For each one of those stratas, there has to be that same ratio. They would want to see 90, 95%. They can't vary from one another any more than 5%, and that's where the trick is. You get the overall 95%, that's easy enough to do. To get all others to land within 4 or 5 points of that is where the challenge is. So that's essentially how we do it. So I just continually adjust the values, follow the data. The trick is just to follow the data and get to that 90, 95%. And once that's done, again, I'm conducting this on the sales, on the 350 sales. I've got that. All those sorts are accurate. I then apply that to the remaining 9,000 single-family homes that are very comparable to that, and that essentially is how the single-family are valued. All of this is submitted to the Department of Revenue, where they go through it and scrutinize it and make sure that it conforms to the standards that I've outlined, that are actually dictated by the DOR, Division of Local Services.
So there were two values that are listed on your final tax bill. And one is for land, let's just concentrate now on the residential properties, because I think that's probably what most people are interested in who are watching the show. So you're going to see two values listed. You're going to see one for land and one for structures of buildings. So would it be fair to say that because we have the two values shown, your sales that you've established, your comparable sales, that pretty much establishes what the market is. But when it comes down to each individual property, there is a process that says you have to take a look at structure value, depreciation, and things like that. So you're using you're using what they call a cost method.
That's correct.
As well. So you use both cost and market methods together to value the properties.
That's right. And getting back to what you said about the land, the land is one of the first things that we value. So first thing we look at are the obvious, the land sales. Typically, we don't always have a lot of land sales, but sometimes we do. So we do analysis on those as well. Failing that, we do, it's called land abstraction or residual land, in which we take the sale price of the property, back off the building value, that gives us what we call an indicated land value, and work with that against the assessed value of the land and see what the ratios are for that. With that in hand, that gives us, what is the land doing? We still have to make that, or have that, conform to DOR standards. With that, then we work on the buildings and continually adjust by the style of the home based on cost indicators. We get some of the cost indicators from Marshall and Swift, a fairly standard benchmark for building values, as well as some of the local builders will often supply us with some of their numbers. That gets us to a more regional area, and that's essentially how we come up with the building values. Depreciation is something that's applied every year. So the first thing is to replacement cost new, and then we back off for depreciation. My home is 100 years old, so it does have some depreciation. I've also done work to it, so some of the depreciation is increased, as I do with any other home that's had work to it.
Right, right.
We adjust the depreciation to reflect the fact.
So you would look at a structure and you'd say, okay, what would it cost to replicate this building new using current materials, current construction methods, and so on and so forth, and then you would apply your depreciation factor.
That's correct.
That's very high level. Okay, and now for commercial properties, what do we do for that?
Commercial properties are similar standards, other than, obviously, we don't have sales. We have some sales, I shouldn't say that, and they have to conform. But the overriding methodology.
But not enough really to establish a market.
No.
Yeah.
Typically, sometimes we do, believe it or not, but for the most part, no. So we have to use the income approach to valuation. We get that primarily through the income and expense forms that we mail out right around this time every year. We mail out about 600 of those. We get a typical return of anywhere, last year was a little bit woeful, but typically we get 50 or 60% return.
Which is well above the state average, I might add.
It is. And I give some credit to the CBA, the Chelmsford Business Association, for kind of helping with some of this. And we get so what we ask for is the income derived from the real estate and the expenses related to the real estate, not the business they're in. I'm not interested in that, just the income with the real estate. With that, in other methods of getting that similar information, secondary sources, we're to develop an income approach to valuation. We can capitalize that income and come up with a valuation. And that's what the Department of Revenue, once again, the Division of Local Services, would want us to take a look at.
So again, on the commercial properties, really, all you're interested in is the actual value of the real estate itself, not any other interest that may be attached to the commercial operation, such as a value of a lease or any goodwill of business or anything like that.
That's
so the
correct.
law is very, very specific that says you can't tax anything but real estate value, okay? Personal property is another situation altogether.
Yes, it is.
That's a tax on whatever qualifies as personal property within the business sphere. So, okay, so that's a pretty good snapshot of what we do. And one thing I do want to emphasize, something that Frank said, I just want to sit on it a little bit because I think this is very important. Although the work is done here in Chelmsford in the assessor's office, the chief assessor and his staff do all of that, those calculations and so forth. This is a highly regulated process. So the local assessor doesn't go free form. He doesn't get to say, oh, well, you know, I think it ought to be this or that. When all that work is done that Frank just described, it all goes into the Department of Revenue, and they have to validate the assessor's work. And very oftentimes, and I've been on the board now, what, 17, 18 years? Yeah.
Yep.
So I've been through the process a few times. And I can't remember a time when they didn't come back with questions. They always kick something back. So they are really pretty thorough, I think.
They are, and the way they handle it is they don't just take my word for it per se, of
Right.
my analysis. I give them the raw data, just the data. They send it through on an Excel spreadsheet. They have macros and do all the sorts that I've done, recreate, if you will, what I've done. And if it doesn't conform, then to your point, that's when they come back and make.
So this is a real case of the checker checking the checker here, right? I mean, they really do their job diligently.
They do, and as long as you're producing it, accurately. So there's no incentive to try and put one past them, frankly, because they're going to catch it. So you just do the work.
Right.
Follow the data, as I said earlier.
Yeah, and I think that's important for people in town to know, that it isn't just some local guy doing his job, that this is looked at very, very closely and scrutinized by the state. That's very important. So now we've gotten to that point. We've sent in the a recap sheet into the DOR, and you've calculated what I call a preliminary tax rate, because a tax rate isn't a tax rate until the select board votes on it. So now what happens? We go before the select board, and what happens next?
As you say, we go before the select board, as I'm mandated each year annually to do in the October-November timeframe once the valuations, up until then, the valuations have been certified. That's apart from what the select board looks at. They're looking at, once again, the tax rate and what it takes to.
Well, we can't proceed to that step until the values have been certified, right?
That's correct. So what they look to is, they look at four things. They look at splitting the tax rate, commercial exemption, small commercial exemption, residential exemption, of course, open space. Their primary, and probably the one that they look at that affects every single taxpayer without exception, would be whether to split the tax rate or not. That simply is, in all of these, are a shift of the burden, of the tax burden. In the case of splitting the tax rate, it shifts it away from the residential towards the commercial, industrial, and personal property. The other exemptions work similarly. Small commercial shifts it just within the commercial class. Personal property and residential are left unaffected, and it shifts the burden to qualifying parcels, to non-qualifying parcels in the commercial and industrial. Residential, once again, just as the residential, and it shifts the burden away from lower properties, lower valued properties to upper properties, to put it in a nutshell.
So in Chelmsford, for example, the select board for the last couple of years, anyway, they've chosen to split the rate, and right now it's at 120.
That's right.
So if you have a split rate of 120, what that means is that if you were to have a unified rate versus a unified rate, if you have a split rate of 120, it means that your commercial property tax base pays 20% more real estate tax than they otherwise would under a single rate. And that extra amount of money that they pay is now deducted from the aggregate tax, the aggregate value of the residential property.
That's correct.
So that's what we're talking about with a shift. So we do that in Chelmsford. And I think right now, Vilo, if you'll put up that slide, and because I think this is a very instructive thing that we can show folks. Everybody is very interested in their property tax bill, and I don't know anybody who's happy about paying it, do you?
Not too many people call and say that, no.
You haven't gotten too many calls saying, gee, Frank, thanks a lot for that bill.
They'll talk about the taxes.
We're going to send you a check tomorrow and happy to pay it, right?
Well, I don't use the word happy.
No, I really don't know anybody who falls into that category, but
Nope.
But for just so that the audience gets some perspective, and we won't spend too much time on this slide. But one of the things that Frank does when he develops the presentation before the select board, he includes a slide that has this data on it. The slide is a lot busier than this. But what this shows is for fiscal tax year 22, which is the latest year that we have complete numbers for, this shows you the relative ranking of where Chelmsford is relative to the towns that surround us in terms of the average single-family residential tax bill. So you can see that there are 10 other towns that surround Chelmsford. Many of them are contiguous or near contiguous to us. And we fall right in the middle. So if you really want to get a good bang for your tax buck, move to the city of Lowell.
Yes.
Because your taxes are relatively lower in Lowell than they are in Chelmsford. But if
Also
you-
shown here is the ranking of 77th. That's an overall for all communities.
Yes, and that's very important. The state rank at the bottom of that slide says that Chelmsford is 77 from the top tax-paying community. So there are 76 communities in the state where the average single-family residential tax bill is higher than it is in Chelmsford. That's what that means. Thank you for pointing that out. But you can see if you live in Carlisle, for example, that's an expensive proposition. So relative to the services that the cities and towns provide, Chelmsford is about in the middle of the average residential tax burden. So, okay, Vilo, thank you. I thought it was important just to get that up there so people could look at it. So we talked a little bit about the split rate, or the split situation, and you mentioned the small commercial and the residential exemptions. Now, we don't do residential exemption in Chelmsford, but we do small commercial.
We do.
So why don't you go into that just a little bit?
We enacted this, or the select board voted this in fiscal 19, the first year that they split the rate. And it's, the qualifiers are this is where it gets into the businesses contained within the property. They would have to be $1 million. This only applies to commercial properties, not industrial. $1 million or less from the valuation, and an average of 10 or fewer full-time employees for all the suites within the building.
Yeah, for each business that's located
That's
on the
correct.
property.
So if they have 6 suites and 5 of them qualify and 1 doesn't because they have 12 full-time employees, that parcel doesn't qualify for the small commercial. It could be, in this case, Chelmsford has gone to the max, and that's 10%. So simply 10% is lopped off the value, and therefore the taxes. That savings is passed on to the property owner. That's a key thing, that the business
Not the business.
Not
Unless
the
the
business
property owner
passes
chooses.
it along in
Right.
some way, shape, or form. That's how that's applied.
And that, Chelmsford is, I don't know, I'd use the word unusual because I don't have you have the perspective, I don't. But it just seems to me that the number of small businesses relative to the number of overall commercial enterprise in Chelmsford is relatively high percentage-wise. So what is the percentage that would qualify?
Well, this year, and I think I reported this to the select board, we had the most ever, close to 300 buildings applied for or qualified for it. Roughly 3/4 of the buildings here in town, 2/3, are probably $1 million or less.
Wow, so it's more than half.
They're well over
Yeah.
half. And I think that's fairly typical. I think I did a little survey a few years ago around communities. Many of them are very similar, maybe not quite as much as 2/3, but fairly substantial amount of them are $1 million or less. We do have, obviously, our 10, 15, $20 million buildings here in town.
Sure.
And we think about Chelmsford's commercial entity, those are often characterized as being the predominant value, and it simply isn't the case. So a substantial amount of the commercial this year qualified. And it makes sense when you consider all the commercial suites that we have, condo suites that we have. It would make sense that a substantial amount would qualify, and they do qualify. It's also worth mentioning that while, once again, it's a shift within the commercial class. So the 10% that's being exempted is passed on to the remaining commercial properties that did not qualify, and all industrial properties share this burden.
And it does not impact your personal property.
It does not impact personal property or residential. That's why we have 3 tax rates and not just 2.
Right, right. That's a confusing thing. So let's talk a little bit about the tax bill itself, because people ask me about this,
Yep.
and it can be confusing.
It's
Now, the first thing that I think we need to talk about is what is meant by a fiscal year, and as it applies in Chelmsford.
Sure. A fiscal year runs from, and in the case of Chelmsford, of the fiscal 23, I should say, July 1st, 2022, through the end of June 23.
All right, so on July 1st of last year, 2022, on July 1st, it was fiscal year 2023.
That's correct.
Okay.
Yep. That's how that's applied. It's also worth mentioning that on these bills, what we call the actual bills, it's full of a lot of information, much of it dictated that has to be on there, once again, by the Department of Revenue. Anybody who compares this bill to the bill they got earlier, the preliminary bill, they'll see that the preliminary bill doesn't have nearly as much information.
That's correct.
We're not mandated to put that much information. Much of it we don't have, frankly. Because now what do we have? We have the actual bill, we now have the actual valuations, tax rate, a number of other things.
So we have, so again, we start with the fiscal year in July 1st of 2023, and there are 4 actual bills that the treasurer's office sends out. And so obviously they're in quarters, right? So that's how we talk about it. So you get your first quarter fiscal 23 tax bill, but that is not the actual tax
That's
bill.
what we call, as you say, a preliminary bill, also known as an estimated bill. And what that's based on, now keep in mind, when those bills go out, there's no valuation, there's no tax rate, there's nothing there to...
You're going off the prior year.
Exactly right. So we go the prior year's taxes paid, split that in half, add the statutory 2.5% that we're allowed to add, and we're also allowed to add a couple other things. We're allowed to add a certain percentage for the excluded debt, which in this case we put in maybe, I work with my boss, John Souza, on this number, and we've held it pretty steady at 0.5%. And then I am allowed, or we are allowed, to any new growth, any substantial changes to a parcel, $50,000, $60,000, $100,000 or more, however I choose, I can include in the preliminary bill. The intent of which is to, if it's a $100,000 addition put on a property, I wouldn't want the additional taxes to be caught up or reflected just in the last 2 payments.
right.
It would be, somewhat
So
overwhelming.
it's almost like an accrual. You're trying to smooth it out over
Trying
the
to
whole year.
stabilize it over 4. And that's
Right,
really the
right.
intent of all of this is to try and stabilize it over all 4 quarters. This year was a little bit more difficult because of the increase in the valuations. So that sort of outpaced it. So people are seeing some more of a dramatic increase going from the second quarter to the third quarter.
Okay, so that's good. So the tax bill that folks just got the last week or so is actually your third quarter bill.
That's correct.
And if you take a look at the bill, in the upper right-hand corner of the bill, it says Town of Chelmsford, fiscal year 2023, third quarter, actual. There it is. So the 2 bills you got for the first 2 quarters do not say actual. Those are estimates, as Frank just explained. And as Frank explained further, now this bill, this third quarter actual bill, if you look over on the left-hand side under where it says property description, that's where you're going to get your breakdown of land and building value, which is very instructive. And then, of course, you add those 2 numbers together and you get the total assessed value for that fiscal year. And that's what your real estate tax is based on. Now let's move over to the middle of the bill. And what is CPF? What is that?
CPF stands for Community Preservation Fund. This was enacted probably, must have been 15 years ago now. It's a fund, it's a surtax, set aside money to go towards 3 different things. Low to moderate housing, places of historical significance, and what's the third?
Open space.
Open space, thank you, which is probably the most active one we've had. But fairly recent farms that come up, large tracts of land have been purchased with this fund. And what it is, it's the valuation of your property minus $100,000 for the residential, times the tax rate, and then 1.5%. And the typical number is anywhere from, I don't know, $60 to $115 a year.
And that's a state program, and towns can opt in or out of it. So,
That's correct.
And I think the minimum amount is 0.5%, and the max, I think, maybe is what?
3.
3. Okay.
Last I heard it was 3.
So we're at 1.5?
1.5.
Okay, all right. And that's by vote of town meeting, so don't get mad at Frank.
Nope.
It's not his fault.
We also
the
get
town
the-
meeting voted to do this back when I was on the select board. So
I
we're
was
going
estimating
back
15 years ago.
16, 17 years ago, they did this, okay?
Initially, it was 0.5%.
And
then
we got a match from the state.
That's correct. At the time, it was almost dollar for dollar
Yeah,
match.
yeah, I remember
Now, I
that.
think it's running at maybe 30 or 40%.
Gee, what a shock that they
But
would.
it's something.
What a shock that
Yeah.
they would reduce.
Well, I think more communities entered into it.
It's still a good thing. I mean, we've done an awful lot of good things with that money. And
Sheehan
the funds,
Farm,
the funds are restricted. I mean, you know, the town manager can't decide, I'm going to buy 3 police cruisers and take money out of the preservation fund. Can't do that. Those funds have to be restricted, as Frank said a minute ago, either to the purchase of open space for the town, or historical preservation acts, or affordable housing, and then only by vote of town meeting.
That's correct. The other thing is, not only are they dedicated to those things, they have to be. At least 10% has to be dedicated to that each and every year.
Correct. Yep, that's right. Very, very important. Now, what else, anything else you want to point out on this bill?
Well,
that I
if you
may
go to
have
the far left where you were talking about under property
missed?
description.
We don't want to go too far left.
All right. No, we don't. No, we don't. Don't be accused of that.
That's right.
You can see the area at 40, whatever the square footage of the lot is.
Yep.
The class, 101 in this case, most people would be 101.
Mm-hmm.
That simply indicates that it's a single-family property. 102 is a condominium. 104 is a two-family. 105 is a three-family, and so on.
And it shows your square footage, your acreage,
It does.
too. Yeah.
It does. The deed, that's self-explanatory. That's the legal reference. The date of the deed, that's self-explanatory. And as you say, the land building breakdown. That's repeated below. If you go to the middle, you see total special assessments. What that is for sewer betterments, sidewalk betterments, that sort of thing. And then it breaks it down, the tax, obviously, the CPF, and the total taxes, then the third quarter. And the way it works is people have paid their taxes for the first 2 quarters. Then I come up with the valuations with the select board's votes on all the different items. We now have tax rates once it's submitted to the Department of Revenue. Now I have an actual bill. In the previous bills that were paid are credited, leaving a balance, and then that's split into 2 even payments for the third and fourth quarter. And then we
Okay.
moved into a different season. We move into the abatement season, the exemption season.
Okay, we've got about a little more than 3 minutes to talk about that.
Okay.
So you guys, folks, you got your tax bills, and then you got this yellow 8.5 by 11 sheet, and the title, enclosed with your bill, and the title of it is Property Tax Exemption Guidelines for Fiscal Year 2023. So we have exemptions, so talk
There are a number,
about
like I
that.
said, we only have 3 minutes.
Go ahead.
There are a number of, there's the elderly exemption, 65 years old. Gross income can be 30,000 and 45,000 for single and married respectively, 40 and 50,000 for a total estate. All of this information, I don't want to belabor the point, it's all on online. If you have any doubts about it, if you can't find it, feel free to give my office a call, 978-250-5220. There's a deferral one in which it's $40,000 from the preceding year. No asset, it's just an income.
Okay, so explain, just a second, take a second to explain what a tax deferral is.
Tax deferral is if you're paying $8,000 a year in taxes and you qualify, then you can defer the taxes until the property is sold someday.
So let's say you have limited income, you really have a hard time meeting that annual tax bill. So you may qualify for the deferral.
You may qualify for the deferral.
Okay.
If you find it, you don't want to defer the whole thing, you can defer part of it, half of it, 2,000, whatever you find comfortable.
That's good. So we do urge people to take a look at these exemptions, because I've been looking at these things for over 15 years, and I just get the sense, just knowing how many property owners there are in town, I get the sense that a lot of people who could qualify don't apply.
Yes, that's very true.
And-
One thing that the select board did do with the urging of the town manager is increase it from a $500 for the
Correct.
to $1,000.
And that was good that they did that.
Yes, it
Yeah,
is.
yeah, so that's good. So we don't want you to pay any more taxes than you are legally obligated to pay. So if you do qualify for an exemption, please take a look at it and ask questions. Call the assessor's office, talk to
Absolutely.
Frank, and you'll get the direction. So last minute abatements. I got my bill.
I'm outraged.
I'm outraged. How dare you say that my property is worth $547,000?
With that,
I don't believe it. What do I do?
you call my office. You can have a form, an abatement form sent to you. There's also a link on our website. If you Google it even, it'll come right up. As long as that form is filled out and returned to my office by February 1st, what that gives me and my board the authority to do is take a look at that parcel and see if maybe we can do something. Maybe the value is excessive. Maybe some of the descriptive data is incorrect. It's the only way that I can lower the value. If it's after February 1st and you drag me out there and I see something egregious, there's nothing I can do.
Yeah, you have to wait till next year.
That's correct.
Right, right. So very, very important, folks. Take a look at your tax bill. And oh, by the way, and no offense to Frank or his staff, people do make mistakes, and there could be an error.
14,000 parcels.
Yeah, exactly. And 3 people in the office to do the work. So take a look at your tax bill, and if you have questions, please call the office, 978-250-5220, or you can send an email. which is?
freen@chelmsfordma.gov. Freen as in Nancy, at chelmsfordma.gov. It's on the website. I'm not hard to find.
That's good, and we're out.